Welcome to this month's Small Biz Virtual Summit. My name is Ken Massa, and I am here with Chuck Boyce. Today, we're bringing on a variety of guests that cover topics and everyday problems that we face within the business world. But our guests are experts in creating solutions to these challenges. And these challenges may be everyday problems that you're facing as a business owner, an entrepreneur, or someone that works in a very amazing business, but you face problems that we all face. Here is a way where you can find those solutions, where you can listen to those who have experienced the same things that you're going through and even come up with a solution that may work for you. It's not uncommon that you've probably heard about needing to have an exit strategy for your business. Although being in the day-to-day works of your business, it seems like it's a really far voyage to get to your exit strategy. And it might even be a little bit more difficult to see what type of acquisition strategies or partner strategies or all of the different types of pieces that come into business to help you create a profitable exit or landing, you might also hear it referred to as, for your business. One thing that we wanted to really make sure we had within our Small Business Summit is someone that was an expert with just seeing all the angles around business, whether it be acquisitions or exit strategies. Today we have JB, who is here to talk about different exit strategies and just business as a whole from all different types of diverse backgrounds. So thank you for joining us, JB. We're really happy to have you on, and we look forward to hearing what you have to say about business and all the angles.
Oh, it's my pleasure, Ken. Really appreciate you guys having me on. Always such an awesome opportunity to talk to small business owners. They're just my favorite people. So anytime that I can chat with folks like that, it's great. So a little bit about me. I founded several businesses, starting with e-commerce and then dumping into home services. And now I've been in all sorts of businesses and had made some nice exits along the way, sort of incrementally increasing in the value of those exits. And at the time, this is, more than a decade ago, as I was going through the process of starting a business, scaling the business, and then preparing to exit. Although in fairness, the first time I can't honestly say there was a whole lot of preparation for that exit, but nonetheless, I managed to exit. It just occurred to me as I did that a few times that there was a significant disparity between my goals and my agenda and what was best for me and the goals and the agenda of the broker at the time that I had worked with on these transactions. And so really dove into making it my business to understand what really makes a great exit and what has to happen, what must be true in order for it to get to a point where you're able to successfully exit a business. So the scale activities that have to happen between whatever time you either found or buy the business and when you're ready to exit. And then also, as a lot of businesses do, there can be multiple acquisitions along the way when you're trying to grow an overall enterprise. The typical client that I work with now is generally 8 figures or more, but I didn't start out that way. And certainly my first businesses were not that large. But at the point that I'm at, I've had the privilege to work with folks from solopreneurs, which I know some of the people listening will be solopreneurs, all the way up to Fortune 500 companies. And you begin to notice similarities and trends, but also some differences in what makes for, a fairly frictionless process towards an exit and what creates a process that's a little bit more fraught with trouble and challenges. And so really, my firm now, we're a full service mergers and acquisitions firm. And, depending on the cycle of the economy, we're either working more heavily upon acquisitions, a lot of scale work, and also exits. A quick note about exits. Exit to me has taken on a nuanced meaning. The obvious definition of exit is that you exit your business, that you sell it to someone. But what we're finding is for a lot of entrepreneurs, exit can actually mean simply them exiting the day-to-day operations. A lot of the same work that you would do to prepare your business and to really structure it well for a true exit where you sell the asset to someone else, it's the same function that you would undertake to make it so that you can exit the business yourself. And what we figured out was there were a lot of clients we'd work with, and we would do all this work to sort of remove them as what I have termed the sort of from like key man's prison. You're the chief everything in your company, and all things roll up through you. And once you remove people from that, regardless of the scale of the business, often the urgent need for them to sort of dispose of the exit, to escape from it, it's just not there anymore. So we changed our business model a little bit to focus pretty heavily upon getting people prepared to really define what a great exit looks like for them. And throughout that process, we've kind of figured out just some key things that I'd love to share with everybody today around, what are the things consistently that we see that businesses of every size do very, very well that will allow them to both remove themselves as the bottleneck in their business and enjoy a little bit better quality of life, and if they choose to then exit that business for the largest multiple or most amount of money possible.
So when exiting a business, I have a question on the exiting portion. I have tons of questions on the exiting portion, actually. But when exiting a business and talking with business owners about the process, do you typically find that the reason they want to exit the business is because of the mundane day-to-day activities or the stress that comes with the day-to-day activities, whereas they could also, per se, exit in the way that you said, where they just simply remove themselves from the business a little bit more seamlessly, opposed to actually selling off the business? Do you find that there's a fine line where you have to draw the difference between the two and find what they're really looking for?
Absolutely. And that was one of the bigger, it wasn't one of, it was the biggest aha for me over, I would say, the past 3.5 years, which was that when you're in a transactional space, any sort of financial service type space, there's obviously your own business that you're running. And so with us, we were primarily running a business model that we were paid when someone acquired a business and we were paid when someone exited a business, and really nothing in between. We did a lot of the work in consulting and advisory with what happened in between those two things. But the challenge we figured out with us was that our agendas were not aligned all the time with our clients, because to your point, we were finding more and more often that working with clients and removing a lot of the stressors that they had, the self-limiting beliefs, exposing them to more efficient, different ways to run a business so that they were not having to be, working the number of hours that maybe they were working, or having the stress levels that they had, and showing them that it's possible to bring in other people to do those things for you. Often those folks would sort of remove themselves from the possibility of an exit because all of a sudden their cash flow is up significantly, revenue's up, profits are up, stress levels are down, and then you run into a situation like, oh, I don't want to sell my business. And we're sort of like, well, wait a minute, we're not going to get paid. And so we really changed our model, because every single business owner, and this is true whether it's someone who's every now and then I don't really work with a lot of solopreneurs, but I have a lot of friends who are, and you chat and kind of share advice back and forth. This is true regardless of the size of the enterprise. If you get to the point where you really do an inventory of what it is that you want, what matters to you, and that's hard work, but you have to do it. If you understand what matters to you and what you're really trying to accomplish in your personal and professional life, it may not make sense for you to fully exit your business for any number of reasons. The reasons that you may want to exit it may have to do with a lot of the things that you just said. And if you can eliminate some of those negative influences in your life, you may no longer need to exit the business. Now, on the other side of that, there are some folks that are what I would term sort of serially restless people. I probably would fit that category. And even if you exited a business because it was just time, it was just, you hear that phrase a lot, like, it's just time. I've sort of done everything that I think I can do. I've met the challenges within this business, and I'm ready to try something else. Or I have this new great idea that I want to launch, or this other project that I want to work on. You end up with folks like that running into a situation where before they realize that they're going to do this multiple times, they'll make an exit and they'll think that that's going to be the greatest day of their life, the day that that cutover happens, and the check clears escrow, and hopefully they have a whole bunch of money in the account, probably more than they've ever paid themselves in a single year times a lot. And the darndest thing can happen where this sense of emptiness and depression sets in. It's happened to me. It's happened to a lot of folks that I know. And you're so confused. And in working with clients, you see it coming. And now we prepare them for it. Because what that really is you've spent so much of your energy, time, focus, and sort of waking energy in building this thing and really making sure that you were constantly solving problems and tweaking and highly, highly focused. And then all of a sudden you don't have that anymore. And it sounds great. And depending on your personality, if you're the type of personality that's a little bit more laid back and the thing was stressing you out, you may be good with that. And you may be able to walk away and you have enough money to hopefully last you for the rest of your life. And you just go fishing. What I'm finding with most pure entrepreneurs is that doesn't work. It lasts for about 2 months. Eventually, you run out of fish to catch, if you catch any at all. You find out that golf isn't actually that fun, and your wife doesn't appreciate you giving her ideas about the way the household runs that she didn't to give her. So then it's sort of like, well, now what am I going to do? So yeah, to your point, we spend a lot of time. We even do personality profiles when someone onboards as a client, because what I need to understand is, who are you as a person? What are your motivations? What is your experience? How do you process information? And one of the questions that I ask folks who are convinced that they want to make an exit, especially if they have a number in mind, is, okay, cool. Well, in a frictionless world, let's say that I get you that number. And let's say that I can get that done for you in 6 months from beginning to end. So 6 months from today, let's say the number is $10 million in your head. I'm gonna put $10 million in your bank account. Now, look, we all know an all cash transaction doesn't happen that often, but bear with me. Let's say I'm gonna put $10 million in your bank account. What are you gonna do the next day? And then I stop and I just shut up and I listen to what they say. And what I'm looking for is, how well have they thought out what it's really gonna be like when they're no longer doing all of the things that they're used to doing that have taken up such a big part of their life. And if I hear, even if it's light on details, if I hear a fairly well thought out plan and it revolves around people, friends, family, new passions that they want to pursue, that's okay. And we can move forward. If I hear, I don't know, or what really gets sketchy is, well, I'm going to buy a Lamborghini, maybe a helicopter. I think I'm going to go, those are red flags in my head that I need to dive deeper with this person into motivation and understand, what's really going on there, because it may not be truly about the exit. And the last thing that I want to do is, even if it meant a big fat check for me, the last thing I want to do is essentially hand somebody a loaded weapon who doesn't fully understand what's about to happen.
Yeah, that makes sense. And I think that's the reason why I asked that question, because I think that depending on the business and depending on the person and their circumstance, how long they've been in the business, the industry, the changes. I mean, there's so many factors that go into business as things change. And the longer that you're in business, the more exposure that you're going to have to these changes. I think that the word exit could have multiple meanings. And it could be exactly what you said, being removed from the day-to-day, or it could be literally selling off the business and its assets. But I think it's important to understand exactly your definition of exit and what it means. But I have a couple of other questions in regards to exit strategy and just exiting as a business owner. Are there any particular hurdles, or I guess what are the biggest hurdles that a business owner would experience through the exit strategy that they have, or through exiting a business? Are there certain processes that they should have in place, or what is the formality behind exiting?
Yeah, great question. And I hate giving this answer, and I'll expound a little bit with some detail, but the real answer to that question is, it depends. Okay. It depends on very much the size of the business. It depends upon the industry. It depends upon sort of how the business has been structured and run. So some things that you consistently see surprise people is not as much in what I would call the SMB world. So let me define that. So an exit that's $5 million or less, maybe even 10, depending on the industry, but an exit that's a $5 million or less exit, you're usually going to find a little bit more of a loosey-goosey process. Now, it doesn't mean that, when you're communicating with the potential acquirer that they're not going to ask you for details to verify. They certainly will. But the level of detail and the level of formality for a deal of that size is very materially different than, a $50 million exit or a $200 million exit. And there's a difference between 50 and 200. So the biggest difference between them is really going to be due diligence and just how in-depth that due diligence process is. I've seen deals that the due diligence was essentially, a couple of years worth of profit and loss statements and a balance sheet, in a customer list, and that was basically it, to a 463 tab, fully filled out Excel spreadsheet with more data requests than you could possibly imagine that took two gigantic teams almost a year to get through.
Wow.
So depending upon the business that you're in, having an understanding of, all right, let me benchmark myself. And if I kind of know where my exit's going to be and where I fit in the marketplace, what is likely to be asked and expected of me from an acquirer in this transaction? So for everybody, this is a true statement. You have to know your numbers. That's rule number one. You have to know your numbers. So, at the very macro level, you need to have a pretty good understanding of your P&Ls. You need to, first of all, have P&Ls that are done, correctly, ideally at least quarterly. I prefer them more frequently, but you want profit and loss statements. You want to understand all of the fields that come on your P&L. And the P&L will be a little bit different depending upon the industry that you're in, but you need to have at least a rudimentary understanding of your numbers in the P&L. A balance sheet, that's more relevant if you have a business that's either, a fair amount of debt involved or heavy assets, things like that. You just want to make sure that you have a good understanding of what are the assets and the liabilities of the business. That's the macro. That's sort of the minimum that you really do have to understand, because if you think about it, just put yourself in the buyer's shoes. Would you buy your business with the information that you today are ready to provide in a clear, cohesive way? If the answer to that is not a resounding yes, then you have work to do, and that's okay, but that just means you're not ready yet. On the micro level, digging a little bit more into the weeds, and this is not, it would be easy to say this is true of SaaS or tech or e-com only, but it's not. You need to understand what it costs you to acquire a customer, regardless of what industry that you're in or what you're selling. You really have to understand the economics of your business. So you need to know what it costs you to acquire a customer. You need to know roughly what the average, ideally lifetime, but if it's a singular transaction, then just the one, what the average value is of every single one of your customers. You need to know what it costs you to produce either the product or service that you're providing to them as a business. And then you also need to know, this is one that folks miss a lot, you need to really understand your true overhead and be able to allocate the percentage of overhead that it costs per each sale, if you can. Now, there are some industries where that's harder. You can kind of fudge it a little bit, but these are the bare minimum of things that you're going to be asked. And so if you don't know the answers to those questions, then you have some work to do. And you have to sort of build those things out.
So as we're talking, you both know I exited about a year and a half ago from a company that I built and ran for about 15 years. And it's great to kind of hear JB running through the list. Couple of just from a very, very recent perspective. The one thing that I would add is, especially in the diligence section, potentially less about the business size and the industry, but driven, certainly in my case, selling to a public company, who the acquirer is drove more of what those requirements were, and in my case, when you're dealing with a regulated, publicly traded company, even on a small, 7-figure exit, the requirements are going to be significantly different. So you'll see that a lot of times in industries where roll-ups are happening, and you've either got a PE or a publicly traded company that are buying up these smaller. So you've got to kind of keep that in the back of your mind as who my ideal acquirer is, and then I can share with you. We spent a year. And I was pretty much out of the day-to-day of the business. So when it comes to reason for selling, I was pretty much out. But, as JB mentioned, I'm like the restless entrepreneur syndrome. I was done. I'd spent 15 years building this business. So it was really time. It was a good time for me to go, and it was the right time. It was some market timing as well. But we spent a year getting the business ready before we even engaged our broker. So that came from my background of having bought a couple of businesses, having been on an acquisition team within a publicly traded company, and having done some other deals. I knew that it was going to take a lot of time, and having outside I can't underemphasize the importance of getting outside help, especially if you're in that space where it may be a roll-up. Things you need somebody that's been there before you. Otherwise, you are gonna get just crushed. If it's the local HVAC guys buying up a couple of local competitors, those deals can be done pretty easy. But yeah, if you're looking, either at the 8-9 figure exit or being acquired by a much significantly bigger company, you really want to make sure that you have that outside help, and you want to engage them early.
Yeah, that makes sense, right? Larger corporations are going to have much more regulation revolving around them. So
that 400 tab spreadsheet was sounding awfully familiar.
I thought it might to you, Chuck. And you make a great point, because yes, the buyer is disproportionately important, because a publicly traded company, the joke that I make that's not going to sound funny to you at all if you've gone through it, is if you're selling to a highly sophisticated buyer, and I put a publicly traded in that same bucket, the same is true of a really, really good PE, or even a large institutional strategic buyer that's maybe buying up other ones. It's just about like going through a year-long colonoscopy is what you can expect. Like, nothing is hidden. You can't really, anything that's there. And so the reason that I think it's a very important point that you shared as to why you want to try to ideally bring someone else in who's a neutral third party, who doesn't have any preconceived notions about what you're doing. But even if you don't, the reason you want to endeavor to start probably a year before you want to exit is any weakness that exists, any skeleton in the closet, any friction-filled process or quirk in your business will 100% be used against you when it comes time to either make the letter of intent, or more often than not, it doesn't come out until the LOI is already executed and you're months in. And it's sort of a thing where a lot of these companies will come back and after they've just, wined and dined you and told you how wonderful your company is and how amazing you are, they'll sort of come in at the last minute and say, hey, we found 37 problems and we're going to cut our offer in half. And if you don't take it today, because it expires in 15 minutes, we're going to go tell every one of our PE or other folks in this space how terrible of a company you are. That sounds scary, but it's real. It does happen. So great point.
Well, and I think the other benefit of using an expert or an intermediary is the amount of emotion that we as owners, this was our baby. We've built this from scratch. And then having a filter, having somebody that I can yell at, who understood my position, but could then be the filter and walk you back from that ledge. Because every deal that I've been involved with, even peripherally, there gets to be the point where frustrations are high, everybody's on edge. There's a lot of swearing going on. and you need a grown up in the room. And surprisingly, a lot of that was coming from the other side in my particular case. So it was nice to kind of have that have that buffer there, invaluable, worth every dollar that they got paid.
To give you a little inside baseball, you just hit on a dirty little secret of folks that are intermediaries, really of any kind. And look, we have a lot of different names. On the small side, you tend to see folks that identify themselves as brokers. And that's really what they are, because they're very transactional in nature. When you get up into, billion-dollar deals, you're talking really investment banks, and somewhere in the middle are M&A advisors, which is where I live. And the reality is, most business owners that work in the space, just from a revenue perspective that I do, they're pretty good with numbers. They're not idiots. They're sharp people who have gotten to a certain level. And, I'm good, but not usually any better than they are. What I really get paid for is what you said. And it's my job to be the adult in the room, as you say, to be sort of unflappable, to kind of just be here all the time when everybody else is here or here. And is another piece that you didn't say, but that is crucial in one instance. If there's a situation where it's not a true and pure immediate exit at close, and for some reason, which happens often, the founder is going to, for any number of reasons, have to continue to be involved for a fixed period of time. Well, here's the challenge. If you have a particularly contentious negotiation where these types of things happen, and then you're going to have to work with these folks for a year or two or longer, you can really create a situation that is not going to be fun, because nobody forgets these types of things. It would be easy to say, all is fair in negotiations and deals, and nobody holds it against each other, but that's not human nature. And so what you don't want is for, in my case, for the seller to be in a situation where they're extremely angry about something and they have to say something in a way that the other side is really not going to like. Sometimes what I'm really paid for, other than the things we've already talked about, is the seller will say it to me, and then I'll be the one who says it, because it doesn't matter if they're pissed off at me. It doesn't matter if they don't like me, because as soon as the transaction's over, I'm out. So in a way, when you're an intermediary, you play whatever role is necessary to protect your client, both in the now and also in the future, if there has to be an ongoing relationship, so that relationship, if it's dependent, even earn-out is dependent, it's not sabotaged before it even begins.
Yeah. That makes sense. I want to flip the script for one kind of question here that poses a question on the opposite side of the table. I've seen both sides of the deals, from purchasing and selling, but from a purchaser's perspective, what are you looking at to make sure that the business that you're acquiring is in alignment with expectations, whether that be profitability or the assets that you're purchasing? Are there certain guidelines that you think should be put in place when evaluating a business for purchase?
Oh, absolutely. So the neat thing about being able to work both sides is that you get pretty good at being able to have empathy for either side, depending upon, you're a mercenary. So depending upon which side you're working that day. And then in my own, investments, a couple times a year, I'll snap up a business myself if I notice that there's significant value. So the things I'm looking for on the acquisition side are, at a high level, a very clear, easy to understand story. That doesn't mean that the business itself has to be simple. There's different levels of complexity across different industries, but I need to be able to look at the business and, for the most part, be able to map out the story of how this business came to be, whatever state that I found the business in, whether they're doing extremely well, whether they were doing well and now they're doing poorly. I just want to be able to have a logical story in my own head as to how that came to happen. I also, anything that I'm told or anything that I see, I want to be able to verify at least two different sources from. So this is where understanding how to read P&Ls, understanding balance sheets, understanding debt structure, understanding vendor management, vendor contracts, customer acquisition, everything that you would need to touch upon in a business, you at least want to have enough of an understanding that you can ask the important questions. Because what you're trying to avoid is gotchas. You don't want to find yourself in a situation where you acquire a business and then 2 months later something just catastrophic happens because you didn't think to ask a question and they weren't really. It wasn't. The onus was not upon the seller to disclose it to you. So it also depends on if this is a singular acquisition. A trend that's happening a lot right now is you have business schools, very prestigious business schools that they've recognized that a lot of these B school grads don't necessarily want to go work for KPMG or Ernst and or Bain. They want to go do something themselves, so they're leaning into that. And what they're teaching is essentially lower middle market acquisition with some combination of leverage and maybe a search fund where you have other people jump in there. And the thing that you're seeing consistently there is if it's a singular acquisition, there can be an over focus on what the business in a silo is able to produce. And the reason that that's an issue is because when I'm evaluating any single business and I look at it, today's present value, I better be able to understand how I'm going to increase the overall revenue and profit of that enterprise, which may be growing it organically within that silo, but it also may be that I already know if I'm going to acquire, let's just say that I'm going to acquire, we'll keep it small. Let's say I'm going to acquire a landscaping company. Let's keep it really simple. And a landscape company is going to cost me, $10 million to acquire. Let's say its margins are good and it's throwing off, $2.5 to $3 million a year. Well, if I look at that business and I know that it's spending $1 million a year, which would be high, but let's say it's got a 10% marketing budget. If it's spending $1 million, well, that also tells me that it may be wise of me to go ahead and look for a small marketing company that I can also snap up, because one, I'm going to more than pay for that acquisition with the savings that I'm going to realize in the reduction in my marketing budget. Can probably also make some money and get some additional intel on my competitors. I'm also going to look for, supply chain things. If there's certain products that I'm consistently buying, is there a way for me to vertically integrate and to acquire some of those suppliers? So I would say the biggest thing is understanding where the business came from and how it got to where it is today, and making sure that all of the things you're being told and everything that you see makes sense and that you can validate it. And then also knowing what is your end game, because I don't buy anything unless I already have a pretty good idea of how I'm going to exit it. It's no real different than real estate or stock at that point. You want to be able to understand what your exit point is and how you're going to get there. And there can be a lot of moving parts that go into that.
That makes sense. Yeah, I completely understand both sides of that picture. And I think that there's certain criteria that goes with each side of it. So I think that makes sense. As a whole, you answered a lot of the questions that I had from both sides of the table, whether it's a purchase or it's a sale of a business. Chuck, do you have any last questions for JB?
No, JB, what would be the one kind of big takeaway that you would want somebody to think about, or the one action step that they could take that they would that they could use to kind of start to set themselves up, whether they were looking to acquire a business to grow or if they were looking to sell their own? Is there one kind of first step that everybody should be thinking about and considering?
Yeah, if I had to pick one, it sounds really simple, and it is, but it's not easy. And it's to start with the end in mind. Understand where you're trying to get to over whatever time frame that you have. If you're 55 years old and you're looking at your retirement account and you're concerned about your ability to live the rest of your life, we're all living longer, hopefully. That doesn't mean that you can't go buy a business or acquire a business or start a business at all. It just means that your time frame may be different than someone who's 25 years old. So I would say just make sure that you start with the end in mind. Be nimble and ready, willing, and able to make sort of micro pivots, because you're not going to know everything. But if you have a pretty good idea of where you want to end up and how long you have to accomplish it, everything else you can sort of reverse engineer and work backwards and ask yourself, all right, if this is my goal in 5 years, and the more specific that you can be, the better. Then it's just, okay, let's pretend it already happened. What things had to be true in order for that to happen. And then the rest of it sort of becomes a series of systems and processes that you can put into place. But you have to start with the end in mind. Where folks get in trouble is they just sort of willy-nilly go out and say, I want to buy a business. And there's no real rhyme or reason to it. And I've had folks tell me, the same guy in the same 2-day span asked me about buying a med spa, a nightclub, a car dealership. Like, there was no logical rhyme or reason. And then the one thing that I forgot to mention that's important to this is spend $50 and get yourself a personality profile and have somebody that understands personality profiles go through them with you. Because here's the reality. Not all of us are designed just with the way God made us. We're not designed to run every business, and we're not also designed for every function in every business. So if you start off with knowing a little bit more about yourself and you know kind of what your end goal is, the rest of it can fall into place.
No, that's so true.
Yeah.
So true.
Yeah, I mean, I think we've all experienced that, particularly on this call, with just the exposure to businesses that we've had and the different opportunities in sales of businesses or acquisitions of businesses in and of itself. Personality is important with the business niche or vertical that you are in. So I can see how that's impactful.
Absolutely.
So JB, we really appreciate you joining us today, and always dropping a ton of knowledge on us. I think you've given us all a lot to think about, whether you're new to the idea of buying or selling businesses, or if if you're a pro, there's always things that slip through and we forget, where we get caught. So we're going to make sure that your contact information is available for anybody that can reach out if they've got questions for you. We'll make sure that we get them in touch with you. So again, really appreciate you taking the time today.
Thank you, JB.
Really
appreciate having you on.
Appreciate you guys, and thank you so much for what you're doing and bringing this value to the small business community. It's so needed. So kudos to you.
Oh, thanks so much.
Thank you.